Okay, good morning, everybody. This is Adam Goldstein with the Federal Home Loan Bank, Chief Business Officer, and I
experience that essentially.
Today we're fortunate to be joined again by Kristina Hooper, Chief Global Marketing Strategist for Invesco. Our audience will recall that the presentation that Kristina provided at the start of the year was absolutely outstanding. We received some of the highest ratings from any of the webinars we've done, so we asked her to come back to talk about topics ranging from inflation to policy and the implications on the economy. We're excited to have her back with us today to discuss mid-year investment outlook, offering her perspective on insights into the current market and beyond. But before we do, turn it over to Kristina, just a couple updates from the Federal Home Loan Bank. We are about to celebrate a very big anniversary at the Federal Home Loan Bank. On July 22nd, the Home Loan Bank system will celebrate our 90th anniversary. And across our 90-year history, our membership and our mission has evolved to meet the needs of the market. The defining principle of the Home Loan Bank system has remained stability. The underlying strength of the Federal Home Loan Bank comes from our cooperative structure. We are both owned by and a partner to you, our members. You trust us with your capital and rely on us for on-demand funding, and together, we raise up the communities that we all serve. It is this partnership that has kept our system in such a vital and reliable part of the economy for the past 9 decades. For 90 years, our members have had a stable partner in the Federal Home Loan Bank, and our entire team is focused on ensuring that you always will. And now to kick off the webinar, I'd like to turn it over to Tom Citino, our Director of Member Relations. Tom, take it away.
Hey, thanks, Adam. Good morning, everyone. We have a great crowd today, so I really appreciate everyone's attendance. And it's really a pleasure to welcome back to Speaker Kristina Hooper, Chief Global Market Strategist at Invesco. So just a little background on Kristina. She leads a team, the Global Market Strategy Office, and she's got teams located in North America, Europe, and Asia. And her teams formulate macro views of the markets and economy, and then also examine the investment implication of those views. Prior to Invesco, Kristina has had a stint as U.S. investment strategist at Alliance Global Investors. She also held positions at PIMCO Funds, UBS, and also at our member, MetLife. And then Kristina is regularly quoted in Wall Street Journal, Financial Times, Reuters, and also has appeared regularly on CNBC and Bloomberg TV. So we're really happy to have you today, Kristina.
It is hard to do. Fantastic. Thank you so much for having me, Tom, Adam, everyone. This is just a pleasure to be with you all. So what I'm going to do is walk you through some slides that really encompass our mid-year outlook. But let's face it, a lot has changed in just a few weeks since we released these slides. So I'm going to be talking you through some of the changes, some of the updates that you would have seen in the slides if we had the time to do them, data that has come out in recent days, etc. And I hope to leave enough time for adequate questions. We can really take this in any direction you want. But to get started, if you don't mind moving to slide 4, that really lays out our outlook, not just our base case, but 2 alternate tail risk scenarios. You may remember when I last came, we have gone through what I would call a mind thing. And that's really because we certainly have one view that we feel strongly about, but we also recognize that, especially in this incredibly rapidly changing environment, that tail risk scenarios are very real possibilities, and they can go up and down in probability. So our base case, as you can see, is one in which the status quo remains with regard to Russia-Ukraine tensions. So they don't get worse, they don't get better. And that means some inflationary pressure coming from commodities, but not much of a big increase because, again, it's a status quo with Russia-Ukraine. Now, in this environment, the Fed tightens, and the ECB lags behind the Fed. And that's what we've seen thus far. We think that's going to continue. And the People's Bank of China has eased. So different economies in very different places for reasons specific to those economies. Growth is lower, and in fact, we're in a significant slowdown triggered by the Fed. But in the base case, we avoid recession. Now, The likelihood of that happening is certainly decreasing as we get the kind of inflation prints we're seeing. Just CPI and PPI this week have increased the odds of higher rate hikes, which in turn increase the odds of a recession. But that is our base case, is that the US will go into a significant slowdown, but avoid an actual recession. At the end of the day, though, I will say it doesn't really matter if it's a significant slowdown or a mild recession. We still don't think we're going to see significant damage, and we point to the labor market strength as a key reason why. Now, one alternate tail risk scenario is, I would say, a very upbeat scenario, one in which tensions between Russia and Ukraine de-escalate. That reduces inflationary pressure, especially for Europe, which has been the epicenter of the damage with regard to this energy crisis. That interestingly leads to a scenario where some central banks might actually feel more comfortable hiking rates to combat other forms of inflation because they don't believe their respective economies are vulnerable. I don't think that's going to be the case with the United States, but it could certainly be the case with the ECB. The other alternate tail risk scenario is close to a worst case scenario, and that is an escalation in tensions between Russia and Ukraine, which just exacerbates our problems, increases inflationary pressures, and increases the downward pressures on growth, and essentially ensures a recession in many places, really a stagflationary environment for Europe, which again is the epicenter of the problems. But US specific, this is a story about the Fed. And if the Fed can navigate a slowdown, can cool demand, which is its objective, without sending the US economy into recession. It is very, very hard because, as we know, monetary policy is not a surgical tool. It is a blunt instrument. But I will say one advantage the Fed has is that it is truly data dependent. So it is turning that blunt instrument into a bit of a surgical tool. Because it is reacting to incoming data. Now that can work in both directions. As we saw in June, Jay Powell admitted at the FOMC press conference that essentially two data points, inflation and Michigan inflation expectations, that preliminary number was significantly higher than the previous month. Those really convinced the Fed to do a 75 basis point hike, which up until a week before had been essentially considered off the table. So that can work in the other direction in that the Fed can be a little more precise and react if it sees demand is cooling significantly and inflation is starting to moderate. It can pull back on an aggressive path. So to me, that data dependency, which truly has happened in the last meeting, could be a benefit in terms of avoiding recession. So let's turn to the next slide. And one of the issues we face is just how unusual this recovery was. You may remember this slide from earlier this year, and it shows this incredible downturn for the pandemic. Hardly anything, relatively speaking, for the global financial crisis, despite how severe that was. I mean, it was a real V-shaped downturn and recovery for the pandemic. And that carries with it good news and bad news. There was significant fiscal stimulus, which we didn't have during the global financial crisis, and that helped a very rapid jobs recovery. And that's why we have such a tight labor market. However, the speed of the recovery in many ways dooms its longevity, right? There needs to be a slowing down of that rebound in order for it to be sustainable. And that, of course, is what the Fed is trying to do. It's hard. And of course, this is not a US only problem. This is a G7 problem. They all gave a lot of fiscal stimulus in this crisis, and they all experienced that essentially V-shaped recovery. And so it's all about how do we manage that? How do we cool demand so we can essentially engineer a slowdown that does not turn into a recession? It is hard to do, especially since we have gone through what I would call a monetary policy whiplash in terms of how quickly expectations have changed for the Fed and actually for other Western developed central banks. If you turn to the next slide, what you'll see is our US dashboard. Now, I think I created this chart and it shows us a little stale. So I'm just going to walk you through the updates. Not surprisingly, what you'll see is created this chart and it shows a significant difference from the environment that we lived in for not just a decade earlier, as this chart shows, but as you all know, 30 plus years before the pandemic, we were in a low inflation environment. There are a number of reasons for that, and some would argue those longer term trends will bring down inflation, that this is very much specific to the crisis that we experienced and the way we solved for it with a lot of stimulus. But be that as it may, CPI is high and PPI print that came out this morning was very high as well. So it doesn't bode well. I mean, we still think inflation will peak relatively soon, but it certainly doesn't bode well for the inflation picture today. And the Fed is focused on credibility today, which we've heard in recent speeches from Fed officials. Now, if we turn to the next chart, it's the Treasury yield curve, the 2s and the 10s. Oh, now same slide. I'm sorry. The next chart on that's on slide 6. So if you look at the 2s and 10s, as we know, it inverted the other day and is now, I think, about a 25 basis point spread the last time I looked. Now, what do we know about the 2s and 10s inversion? Well, we saw it previously in early April, but it was very short-lived. Typically, it is a good predictor of recession, but it tends to need to be sustained for about 3 months to be very predictive. And in fact, the 3-month 10-year has historically been considered a slightly better indicator of recession. So certainly we want to pay attention to the 2s, 10s, but we have seen a fair amount of volatility there. But right now it's suggesting that we could see a recession again if that inversion continues for the next 90 or so days. So I just want to take that inversion with a grain of salt. Now, another indicator typically of recession is the spread on triple Bs. And usually you want to get to that 320 basis point level to see that. We're at about 210, I think, when I looked this morning. So we're nowhere near the danger zone. And that speaks to the environment we're in, where companies rushed to refinance. And so many are enjoying low rates, and they're in a fairly good place, and there is no cliff coming up in terms of the need for a very significant number to refinance. It's actually pretty low because so many companies took advantage of historically low rates before they started to go up. Now, triple C spreads are in a different place. We know they got above 1,000. They've remained above that. So we want to be alert to that. And that speaks to the concerns about lower quality debt in this environment. And then finally, the US dollar. Well, what we know about the dollar is that we tend to see movement, we tend to see strength in expectation of rate hikes. And so it's no surprise that as there has been such a pivot in terms of expectations around Fed tightening, that we've seen US dollar strength, so much so that the other day, US dollar and euro currency reached parity. We haven't seen that in like 20 years. That is, to me, part of the thesis that the Fed is going to be very, very aggressive going forward, and other central banks like the ECB just aren't. And we can go into why I think that's absolutely the case, at least for the shorter term for the Fed. I do think we're going to see some aggressiveness in the next couple of months, but I do think there's room for a less aggressive path in the last quarter of the year. So if you turn to the next slide, one of the questions we get is, what is the direction of economies? And obviously, slowdowns in the US, even more severe slowdown in the Eurozone, just again, because of the unique nature of their crisis. Their inflation is being largely driven by energy prices, whereas in the US, inflation is far more widespread. It's coming from a variety of sources. The problem with energy inflation and commodity inflation, it's very, very hard for central banks to control for. They can't solve for it, in fact. The only thing they can solve for is a cooling of demand. The ECB doesn't have a big issue with having to cool demand. The economy, the Eurozone economy is more vulnerable. So it's about the US trying to cool demand. So of course it's going to be a slowdown. It's just a question of how significant a slowdown, and will it be a mild recession? And as I mentioned before, does it really matter? And we'll go into that in a minute. Now, interestingly, juxtaposed with the US and Eurozone is China. Now, you may recall China was first in for the pandemic and first out. But then it went in again. The Omicron variant was something that could not be protected against by normal protocols in China. And so we saw very, very significant lockdowns because of the zero COVID policy. Now, the government policymakers decided probably late April, early May to start changing their approach. And so we went from zero COVID policy to dynamic zero COVID policy to dynamic social zero COVID policy. And really all those words mean is that we're not going to have citywide lockdowns. We are going to have very targeted lockdowns, could be your social group, but there is daily testing going on in China. So if you can believe this, people have to go through daily testing. It is free. And it's relatively inexpensive for the government as well. They're doing widespread testing. So I think they have a very good handle on infection rates, and they are far lower than in Western countries. And the rollback has occurred in terms of the lockdowns. So we have economies reopening, and we can see that in the PMI data. Services PMI went from contraction territory in May, made a big leap in June into expansionary territory, well into expansionary territory, which suggests to me a strong rebound for the Chinese economy. And the likelihood of going back to where we were is very low because of the policy changes. We also have in China a very different fiscal policy landscape and different monetary policy landscape. While Western central banks are tightening, China is loosening. People's Bank of China is very accommodative and getting more accommodative. And then, of course, we also have fiscal stimulus that's quite significant that I'll get into in a minute. But that's the difference in the direction of economies. China will likely see growth by next, an improvement and acceleration in growth probably later this year. Well, really in the back half of this year, that should continue well into next year. So if you turn to the next slide, obviously, one of our big issues has been commodity prices. As I said, a bigger issue for the Eurozone economy because of their dependency on Russian energy, but it's been an issue for the entire world. It's been an issue for emerging markets countries. It's been very problematic, and it's why real incomes are going down. Now, the good news is we've seen a reversal of this. This chart was created a little while ago, and we've actually seen commodity prices come down in recent weeks, and that should alleviate some pressure. And it's one of the reasons why I would suggest that we're close to peak inflation. There are some areas where we're not seeing significant inflationary pressures. And yield curve, the twos and the commodity prices. I would also point out, if you looked at the last jobs report that came out last Friday, average hourly earnings were subdued in terms of wage growth. And that's a good sign, because wage growth tends to be one of the stickier parts of the inflation picture, and can be problematic in terms of causing inflation to become more entrenched. So let's turn to the next slide. Obviously, we're in an environment of tighter financial conditions, and that is on purpose, right? The Fed is doing this on purpose. Now, the problem is how significant the pivot has been. I mean, I'm sure we've all heard clients lament for years now about ultra low rates and how much they dislike this, how unusual and unnatural it was. Well, the problem, everyone wanted a higher rate environment. The problem was going through that can be difficult, especially given the change in expectations has been so dramatic. So a colleague of mine puts it this way: everyone wants to go to heaven, but no one wants to die. And I hate to use the word die because we're not going to die going through this, but the reality is we're probably all going to be far better off in a more normal, higher rate environment. We just have to live through the ripping off of the Band-Aid, which is essentially what's occurring now. So in particular, we're seeing significant pressure on housing, given that mortgage rates have gone up. Now they came down last week, now they're back up substantially. And I suspect that the direction is going to continue to go up. But again, this is a source of inflation. This is an area where the Fed needs to cool demand, even though there are other problems in terms of a lack of adequate supply. But it is what it is, and this is essentially what the Fed needs to do with its blunt instrument, is to tighten financial conditions, and there are going to be areas that are affected by it. If you turn to the next slide, though, and this is something I really hang my hat on, is that inflation expectations over the longer term remain well anchored. And that is something that if you go back and look at the language of Fed announcements, if you look through FOMC minutes from the past, that has always been a focus of FOMC policymakers, is are inflation expectations well anchored for the longer term, because that, of course, can dictate longer term, more entrenched inflation. What we saw in the 70s was that inflation expectations were not well anchored. And that's why people bought today, expecting prices to go up and essentially making it a self-fulfilling prophecy. So market-based inflation expectations have come down. This chart is pretty accurate, even though it's a little old. I mean, we've actually seen expectations come down nicely in recent weeks. And in terms of looking at consumer inflation expectations, I mentioned that preliminary Michigan print for the 5-year ahead period startled the Fed because it went from 3 to 3.3%, and that was one of the catalysts for doing a 75 basis point hike. Well, then the final read came out for June, and it actually was 3.1%. So not as much of a cause for concern. And in fact, we got the New York Fed print, 3-year ahead inflation expectations this past Monday, and it shows those inflation expectations actually came down. So the 1-year ahead went up and the 3-year ahead came down. So that again suggests longer term inflation expectations remain relatively well anchored. And so I suspect that the Fed, to maintain credibility, will hike aggressively in the near term, that we will get 75 or even 100 basis points at this meeting, and that we will get 75 or 50 or pretty high number at the next meeting. And there might even be talk about an intraday hike, but I think there will be a taking of inventory in September, that the Fed will look and see how much they've slowed demand, what the inflation picture is like, and they could adjust their path and make it slightly less aggressive for the back part of the year. But no doubt, inflation expectations have changed dramatically. In the December 2021 dot plot, the Fed funds rate was expected to be at the end of 2022, 90 basis points. It is dramatically, we're above 90 already, as we all know, and it's of course dramatically higher. Many expect us to get to 400 basis points. I don't think we're going to get that far. Again, I think there could be a pivot in the last quarter of the year. So if you turn to the next slide, this is again just looking at sources of inflationary pressure. And of course, we did get a bad PPI number, so I don't think we're out of the woods. I don't know if we're going to see moderation just yet, but that we should peak somewhere in the next few months. And as I mentioned, average hourly earnings came down. It was a lower growth rate in this most recent June jobs report. Now, if you turn to slide 12, this is the significant monetary policy pivot I talked about. And again, it's not just the Fed, it's other central banks. The Bank of Canada surprised earlier this week, raising rates 100 basis points. So they're all in this together in terms of trying to combat inflation and just the fears that it will become entrenched, that every month that it remains elevated, it becomes entrenched. And so that's the aggressive pivot. This is just, we have to, I think, take a step back and look at this as, this is how we get to normal. It's not fun. It's not. If we had to plot a path to normal, we would want a methodical, slow increase in rates, but we're not going to get it. Just like most of the things we want in life, we don't get, but we will get there. And I think once we get there, we'll say the pain was worth it, or at least tolerable, because we'll be in a more normal environment, and the kind of environment that I think is very sustainable, without creating asset bubbles, as opposed to ultra low rates, and certainly good for a number of different businesses, ultimately, including banks and financial institutions that are going to benefit from net interest income that's improved. If you turn to the next slide, I talked a little bit about this, about China's reacceleration. Don't pay attention to the COVID-19 cases. They've gone down and they've come up a bit, but as I said, the policy has changed, so I'm not as worried about that now. What I'm focused on is the fiscal stimulus. As you can see, 2021 was not a good year for fiscal stimulus, but 2022 is shaping up to be. In fact, China is issuing bonds to pay for fiscal stimulus. So it is really trying to engineer a strong rebound. I don't think that they're going to hit target this year in terms of about a 5% growth rate, but I don't think they're going to be that far off from it. And again, it's an economy that is directionally moving up. So if you turn to the next slide, one of the questions we're getting is on emerging markets, and I would just say this. We can't treat emerging markets as one asset class. There are a lot of differences among EM nations. For some, commodity prices are just choking these economies, because there's just a lack of affordability, that there's just very, very low disposable income for most members of societies in some emerging markets countries, and households are finding this incredibly unaffordable environment. For others, they haven't seen as much inflation. A lot of Asia EM countries haven't seen that much inflation. So they're in a far better place, and they should be benefiting from a recovery in China, a rebound in the back half of this year. Just a little bit more on dollar strength. As I think I mentioned, the US dollar, and if you turn to the next slide, you'll see the US dollar tends to move in advance of expectations around Fed policy. And so there could be a time in the not too distant future, in the next few months, where expectations change around Fed policy, where it's expected to get less aggressive, and that probably is when we'll see the US dollar plateau. It is not across the board bad for EM countries to have a strong dollar. Those that are commodity-based economies, EM currencies tend to do fairly well because their commodity prices are going up. So they're not as closely connected to the US dollar. If you turn to the next slide, I'm just sharing with you the risk scenario that is a worst case risk scenario, in terms of giving you a sense of where the impact is. And there are some European countries that are going to be most affected. And in fact, many of them are European emerging markets countries, where they are very, very dependent upon energy from Russia. And so that tail risk scenario could be very, very problematic. But a significant effect will be felt by countries like Germany, which of course is a major driver of the Eurozone economy. So I don't want to suggest that we should just be concerned about European EM. There are a number of countries that would be hit hard. And in fact, the UK is actually, while it has a tolerable impact, it will be a real headwind economically. Now, if you turn to the next slide, this is the other risk scenario. And really what we did was we took growth forecasts for these countries before Russia invaded Ukraine. And that represents the light blue portion. So for example, there is the potential that we could see some improvement in growth. We're not going to get back to where we were before Russia's invasion of Ukraine. Some damage has been done that's not going to be easily repaired in the near term. but we could see growth improve and, of course, inflationary pressures go down. But let me talk a little bit about asset class implications, because I think that's what you want to hear, and that's certainly a critical focus of all this. What does it mean for asset classes? If you turn to the next slide, I think it's always important to keep in the back of our minds the historical performance of asset classes in different parts of the business cycle. So let's think specifically about the United States. Typically, what we see is an expansion mode. Equities perform well, and within equities, cyclicals perform better. We see risky credit perform well, right? This is an environment in which, risk assets are market leaders. Now, in the slowdown phase, we tend to still see equity perform well, but it's a different part of the equity market. It tends to be the more defensive, the quality, and the lower volatility. I have to stress that. Now, what's interesting is government bonds tend to do better in the slowdown phase, but again, not as well as equities. Although overall, what we see, companies compression in returns. There are not wide differences between asset class performance. There's not a big performance differential for equities, for example, over government bonds, interestingly. So that takes into, that calls into question, your risk reward profile, and is it worth the extra risk? But in general, equities do perform, have historically performed better than government bonds. High quality credit has done fairly well as well. Risk credit tends to perform less well in this environment, but it's still a somewhat, you could be risk neutral in a slowdown. Our view is that you'd want to overweight equities a little bit, but the defensive side of equities, and within fixed income, investment grade credit could perform well in this environment. And then, of course, there's the contraction phase, where government bonds perform better. Let's face it, equities go down, and that to me is a very different environment than the slowdown. So how do we reconcile the two if we don't know if the US is going to go into a recession or if it's going to go into a significant slowdown? And I don't have a perfect answer for you, but let me at least share that, of course, we're already in a bear market. And that typically the move down in stocks in advance of a recession and during a recession tends to be about 32%. And we're already at, I think, about 23%. I haven't checked today. But so we've already experienced much of the loss that you would see in a typical market, bear market in advance of a recession. And so that gives me hope. And of course, we usually see stocks move in advance, essentially trying to predict where the economic cycle goes. So I wouldn't get hung up on whether or not this is going to be a significant slowdown or a mild recession, because we have already experienced so much of the loss in equities. We need to certainly be defensive in this environment, but also opportunistic, because opportunities are already starting to appear. And of course, there have been opportunities that have been present outside the US. So for example, Chinese equities were so beaten down. And I really, if I go back, I think the inflection point was something like March 15th, where we saw a significant change. We heard from the Vice Premier, who talked about policy changes, a more business-friendly regulatory environment, and that was enough. Valuations had just been really, really attractive on China equities, although we know valuations tend not to be a near-term catalyst, but that was enough, and people started taking advantage of those opportunities, and we've seen a nice performance rebound for China equities. So I think we want to look for opportunities. We want to be thinking about the longer term, but recognize that there's probably going to be more pain before we get there. So let me take you back to one of the first charts that I glossed over, which is slide 3. And this just shares with you Our different asset class preferences, essentially, based on historical performance for the three different scenarios. And as I mentioned, a relatively neutral risk stance for the base case, a slight overweight in equities, a focus on quality and defensives. We could see technology performing well. It's already been beaten down so much, so it's looking more attractive from a valuation perspective, but we do want to be careful in this environment because there's quality tech and there's less quality tech. We would favor quality credit over risky credit. And in terms of currencies, US dollars likely to remain strong for the next few months, and I would expect, given expectations about the Fed. The Canadian dollar should benefit also because its central bank is quite hawkish, and also it's a somewhat commodity-based currency. In the Russia energy cutoff, that's that bad case scenario, you would want to move to a more defensive stance, to be underweight risk. That's an environment where being defensive is very important, and in particular in areas like the Eurozone, which as I mentioned would be the epicenter of the damage. And then alternatively, that Russia-Ukraine de-escalation, that better case scenario, would be one which you'd want to be a bit more risk on. So that just gives you a sense of some asset class preferences based on historical performance. But again, I want to give the caveat: every environment is slightly different. It's history doesn't repeat itself so much as it rhymes. But this can be, at least some food for thought in terms of areas of opportunity and what might happen. But again, we could be seeing multiple environments in the course of the back half of this year. One environment during the Fed's aggressive phase, but if it were to then pivot to a slightly less aggressive phase, that could be a more risk-on environment on the assumption that the Fed has done much of its tightening. There are expectations by a lot of market participants that at least by next year, the Fed should be finished with tightening because it's pushed the economy into a recession. Again, that's not my base case, but if you follow that through, and we know that stocks tend to forecast what is going to happen, there could be opportunity in terms of picking up stocks near that inflection point. But again, I think there's going to be a rebound before then, and the Fed could very well be the catalyst, since it has been such a critical driver of performance. So I know I've blabbed on and on, so let me stop here and see if there are questions.
Thanks a lot, Christina. So this is Tom from the Home Loan Bank. I had a question for you with regards to the 10-year Treasury. It's at 297 now. Where do you think it's going to end up the year at the end of the year?
So I have to caveat that with, there are so many factors driving the 10-year, right? But I do believe that we're going to see the 10-year move a little higher. So it's very hard to give an exact number, but I think directionally it will move higher from here. And part of that, of course, is my thesis that we will avoid an actual or significant recession. So the growth expectations will not be in the toilet, so to speak. And so I would anticipate the 10-year being in the probably low threes, though don't quote me on that, but I think directionally higher than where we are today.
Okay, thank you. I know you had talked about looking for pockets of opportunity, and then you had talked about some international markets that there's potential opportunity. What about in domestic markets? What segments of the market do you think there are pockets of opportunity for investors today?
So I'm excited about technology. I know that is very, very hard to say given what we've seen in terms of the NASDAQ performance. And again, valuations are not predictive in the shorter term. But there are a lot of quality tech companies. We're not back in the early 2000s with the tech bubble bursting and people sifting through a lot of garbage and carnage. There are a lot of very, very strong companies in the tech space that are cash cows, high quality companies, some of which actually pay dividends. So to me, this is a sector that's been beaten down, and some of the sector has been beaten down rather unfairly. And while we know that tech tends to be hit harder, as with higher valuation stocks when rates go up, which makes sense, that doesn't actually continue for the entire rate hike cycle. At a certain point, there is digestion, and higher valuation names like tech can perform better. So if we go back and look at full rate hike cycles in the past 20 or so years, tech has not been a bad performer relative to other sectors. So a bunch of reasons why. I also think companies, while they might be prudent with CapEx spending this year, given the economic headwinds, I think they're going to be willing to spend on technology. They have more hybrid workers, just more need for things like software, cloud computing, security, that kind of thing. And also some companies, of course, are functioning with fewer employees than they would like. So they need to enhance productivity, which would be another reason for CapEx spending on tech.
So there's upward pressure on Invesco's QQQ fund?
We'll see. We'll see. I mean, you know, again, sometimes this
Yeah.
will take time, but I remain optimistic that technology is an attractive place. I think we should be sniffing around.
Okay, good. Have another question. You had talked about the potential of a 100 basis point rate hike, and then you had mentioned Bank of Canada did a 100 basis point rate hike. What do you think the probability of the Fed doing a 100 basis point rate hike at the end of July?
That is a great question. I would say I don't know, because the Fed is being data dependent. So I'm going to be watching really closely at Michigan inflation expectations. I'm going to be really looking at any print that might impact the Fed's decision that we haven't already seen. So right now, I think it's far more probable that we see a 75 basis point rate hike. But if we get Michigan 5-year ahead inflation expectations from consumers that is well above 3.1%, I think there's certainly the potential for a 100 basis point rate hike increases. But in my mind, it's still a lower probability than 75 basis points as I stand here today.
Okay, fair enough. Here's an interesting question someone had. Do you see any possibility of a new Plaza Accord to deal with this super strong U.S. dollar?
So the Plaza Accords occurred in the mid 1980s, and it was essentially an agreement by G7 nations to keep the dollar's strength down. And certainly there is growing concern about dollar strength right now, just because we hit Euro USD parity. I mean, I think every country likes to have a slightly weaker currency. It's great for exports. It's great for tourism. I hope some of you all get to go to Europe this summer and enjoy the strong dollar. But it, when it becomes so severe, it can be problematic. And so there is talk that there might be some kind of agreement. I just don't see it happening in the near term. I actually would make the call that I think it's much more likely that we see a rollback of some tariffs, some of the US tariffs on China goods, than we would see anything like a Plaza Accord, which, by the way, was reversed after a relatively short period of time by the Louvre Accord. So I don't think so, but it's certainly something that some academics and some economists are talking about, and it might pick up steam, but I think it's a real outlier at this point.
Okay, thank you for that. Last question, I believe, unless something else comes through. What's one thing that really surprised you this year?
Well, I would have to say the dramatic monetary policy pivot. First of all, Russia's invasion of Ukraine, right? Every geopolitical expert told us it wasn't going to happen, or almost every one of them, and it happened. But even more surprising to me was just how dramatic the monetary policy pivot was. I think we all like to believe that central bankers have a better handle on understanding what needs to be done and what kind of policy is the right prescription, essentially. And we just didn't get that. Now, of course, the reality is central bankers have never been very good at that, and they're looking at all the same data we're all looking at, and so they're quite fallible. But for me, I guess the most surprising thing of all, sorry to have a long-winded question, is longer-term inflation expectations. One thing I failed to show you or touch on in one of the charts, the inflation expectations chart, was I showed historically what inflation expectations were like in the 80s and even the early 90s. And long-term inflation expectations were at about the same level as short-term inflation expectations, and were really high, like 9, 10%. So we're in a very different place. Of course, we're shaped by the history we've lived through. We don't know what high inflation is like, most of us. And so we assume we're not going to have high inflation. And in the 1970s, it got so entrenched that there was an assumption that we would have high inflation for the longer term. So it's been pretty impressive to see how relatively well anchored inflation expectations are. I think that provides a little comfort to the Fed, but that might be why the Fed waited so long to get, to take such a hawkish pivot. So I guess a lot of surprises this year.
All right, thanks, Christina. And with regards to if the Fed starts to wanting to start easing and cutting, I guess they don't want to get back to a 0 to 25 basis point Fed funds target. This is much more of a normalized Fed funds target. So I presume they're going to be kind of hanging in there at this level, or where we are at the end of the year for some time. Would you agree with that?
So I could see them cutting next year if we go into recession and it's significant. But I think you're absolutely right, although I would make this one distinction. The Fed views the Fed funds rate as its primary tool. So it's fairly comfortable moving it up and down. Certainly doesn't want to be in the 0 to 25 basis point band, right? But I think it's very comfortable cutting, rates by 75 basis points when it needs to. So I think we're going to be in a more normal range. I think the real policy focus for the Fed, even though it's not talked that much about it, is reducing the size of the balance sheet. And we'll go into that in a minute. That is enormous. When the global financial crisis started, the Fed's balance sheet was like 800 billion, right? We're at this point where it is just enormous now, 10 times that. And so it needs to reduce the size of it. And interestingly, it's already starting to do that. So I think they're going to the Fed is going to be more focused on reducing the size of the balance sheet and not embarking on QE again, which is still very much an experimental monetary policy tool. But I think the Fed funds rate, I think adjusting it, even taking it down to like a 2% level if it's at 4%, if it's, if the environment demands it in the Fed's view, I think that's possible. I just think we're not going to get to 0 to 25 basis points. We're not going to maintain the size of the balance sheet we have now, because that's where the Fed, those are the areas where the Fed views it as being very experimental.
All right, thank you, Christina. Well, that wraps up the questions and the Q&A. We really appreciate your insights today. It was a great presentation. Hopefully everyone enjoyed and found it worthwhile. So that wraps up today's webinar. Thanks again, Christina, and I hope to see everyone back at the next webinar. So thank you and have a great day, everyone.
Thank you.
All right, take care. Bye-bye.